When we talk about valuation, let's be very clear. We're not talking about today's stock price. We're talking about a company's future. But that future is, well, it's written in a language that most people don't really understand. So today, we're going to decipher that language. We're going to look right past the reported numbers to find the real, silent movers of value.
So here's the central puzzle, isn't it? The great paradox of valuation. It's supposed to be a discipline of cold, hard numbers, but it's also an art form. It's about storytelling, it's about interpretation. I mean, how can two brilliant analysts look at the very same financial statements and come up with two completely different futures? Well, the answer is they're reading two different stories.
And the key to this whole puzzle, it lies in a really simple but profound truth. Profit is an opinion, but cash is a fact. That gap, the space between what a company says it earned and the actual cash it has in the bank, that's where fortunes are made and lost.
All right, so let's turn our attention to what really matters. We're going to move past all the accounting rules and conventions and get into the world of cold, hard cash, the ultimate measure of economic reality.
And that brings us right to the heart of valuation, free cash flow. Think of it like this. If a company were a person, free cash flow is the money left in their bank account after they've paid all their bills and set aside enough cash for next month's rent. It's the money they can do whatever they want with. They can invest it, they can grow, or they can give it back to the owners. This, right here, is the ultimate source of all value.
Okay, now look closely here. We start with net income, right? That's the number everyone obsesses over. But to get to the truth, to get to free cash flow, we have to make three really critical adjustments. These are what I call the silent movers of value, and they are the key to crossing that chasm between what's reported as profit and what's actual cash.
So let's break each of these movers down. I want you to think of them as clues in an investigation. Each one is going to tell us something absolutely vital about a company's health and its future.
Our first silent mover is working capital. Now, this isn't just some accounting entry. It's the very lifeblood of a business. It's all the cash that's tied up just in the day-to-day grind of operations. A company that manages its working capital well, it's like a finely tuned engine, just super efficient, super powerful. But a company that doesn't, well, it's just leaking cash, and that is a silent killer of value.
And this table just illustrates that dynamic perfectly. The cash conversion cycle, or CCC. It tells us, in days, how long it takes for a single dollar invested in the business to come back as a dollar of cash. You want to sell your inventory fast, you want to collect from your customers quickly, and, if you can get away with it, you want to pay your suppliers just a little bit more slowly. The shorter this cycle, the more of a cash-generating machine the company is.
Okay, our second silent mover, non-cash charges. I like to call these the ghosts of investments past. See, when a company buys a big factory, the cash is gone right then and there. But accounting rules make that purchase haunt the income statement for years and years in the form of depreciation. It's this phantom expense that reduces reported profit, but no actual cash is leaving the business. So, to find the real cash flow, we have to exorcise these ghosts by adding them back.
And our final silent mover, capital expenditures, or Capex for short, this one reveals a company's soul, its ambition. Maintenance Capex, that's the cost of survival. It's the money you have to spend just to keep the lights on. But growth Capex, that's the investment in the future. It's the bet on a bigger, more profitable tomorrow. And the balance between those two, that tells you everything you need to know about a company's strategy and its vision for the long term. So we have our three silent movers, but this is where the spreadsheet ends and the real judgment begins. It's in the interpretation of these movers that the true art of valuation comes out, and it's exactly where even the experts start to disagree. I mean, just take stock-based compensation. It's a huge expense for so many tech companies. Now, accounting treats it as a non-cash charge, just like depreciation. So the standard practice is to just add it back when you're calculating cash flow. But is that really the right way to think about it?
And right here, the debate just ignites. The purest view is that stock-based comp is a very real economic cost, just cleverly disguised. A company is paying its employees with an incredibly valuable asset, its own stock. Now, this either dilutes the ownership of every existing shareholder, or it forces the company to spend real cash on buybacks to clean up the mess. You see, there is no free lunch in valuation.
And here's another really subtle trap. A company can make its cash flow look amazing by just starving the business of necessary maintenance. It's a deal with the devil, really. You boost your cash flow today by completely neglecting the future. But the future always shows up, and the bill always comes due, and it's often in the form of some kind of catastrophic operational failure.
Okay, enough with the theory. Let's see how mastering just one of these silent movers can create an incredible amount of value in the real world. Let's talk about Dell. Just look at that number, negative 45 days. This has been, on average, Dell's cash conversion cycle. It's a number that seems to defy the laws of business physics. I mean, how is that even possible? It means Dell gets paid by its customers a month and a half before it has to pay its own suppliers. This isn't just good management, it's a work of operational art.
So here's how the magic trick works. You order a computer, and you pay Dell today. They take your cash, and they use it to run their entire business. Then, and only then, weeks later, do they get around to paying their suppliers. In effect, Dell has turned the traditional business model completely on its head. Their customers and their suppliers, they're the ones acting as Dell's bankers.
And this isn't just some clever accounting trick. It's a profound strategic advantage. By having its operations funded by other people's money, Dell dramatically reduces its need to go out and get costly financing. This frees up cash, it lowers risk, and it directly, massively increases the intrinsic value of the business. It's just a masterclass in managing working capital.
So, as we start to wrap this up, let's connect all these technical details back to the bigger picture. Because we're not just crunching numbers here, we're learning how to read a company's story.
You see, each of these silent movers is a chapter in that story. Working capital, that's the chapter on operational discipline. Non-cash charges, that's the chapter on corporate culture and how they really think about compensation. And capital expenditures, well, that's the chapter on ambition. Is this company trying to build an empire, or are they just patching the roof?
So, you see, these aren't just abstract lines in some spreadsheet. They're the footprints of management's decisions. They are the clues to a company's true underlying health. They are the chapters that tell the true story of how value is either created or destroyed. The numbers, they're just the ink on the page. The real work, the art of valuation, is reading between those lines to understand the story the numbers are trying to tell you. So the question isn't whether you can do the math. The real question is, can you read the story?